Welcome to your last case. This is performance measurement at Thomas J. Lipton. So unlike some of your cases, well, most of them actually, this one actually gives you the name of the company. And all of these cases are based on real companies, just that some of them, the names have been changed and adjusted. And I will definitely give you the actual solution, so what the company ended up doing for this particular case when we finish our analysis. I think you'll find that actually quite interesting. This is a wonderful case for us to finish the class with. It incorporates so many of the things that you've learned about, and also goes back to the very first video, the course introduction video, where I talked to you about the objective of a publicly traded company being one in which we have to maximize shareholder wealth. And there's information about returns in this case. I had talked to you about that. So how do we measure those returns for a company? And we finally get to practice some of those computations in a highly sophisticated example. So what we have here is a parent. Parent company's name is Unilever, and the company that we're specifically focusing on, the subsidiary, is called Thomas Lipton. And one of the challenges that they have right off the bat is trying to align their various performance measures from top to bottom. So for instance, Unilever, the parent, evaluates the subsidiary using certain measures. And then the subsidiary, Lipton, evaluates their product line managers using certain measures. And there's issues with what we would call goal congruence. So in some of the different measures that are being used by the different entities, by the parent and the sub, there's a lack of agreement. So in other words, they're measuring different aspects and they don't really align in total. So one of your challenges is to assess that alignment between the two companies to make sure we do have a solid alignment, because you certainly want the subsidiary to measure the same things that the parent is measuring, so that from top to bottom you're all making decisions for the same reasons. And hopefully those reasons are solid reasons, right? And not flawed. This is tricky stuff because oftentimes companies use measures that maybe solve certain problems or create motivation within people to do certain things. And if they're not set up properly, that can also create some behaviors that you don't want to elicit in your organization. So you have to be super careful with this and have a balance of measures to make sure things don't get too lopsided, and also make sure you have lots of parties involved so that there's realistic expectations that are set and it's a participative process. All right, so it's one of your first challenges. And I wanted to mention to you that what you're going to see here is some measures. So for instance, return on sales is the same thing as net profit margin. It takes a profit number in the numerator and it divides it by total sales in the denominator. So it's giving you a return statistic, but it's just based on figures that are in the income statement, which are based on a period of time. So for the last month, the last quarter, the last year. Right, so they can be over a period of time. Other measures that are being collected here are things like return on capital. So that's the measure I had talked to you about in the course introduction video, where you take a profit measure from the income statement and then you divide it by a balance sheet item, which is usually total assets minus current liabilities, which is what this company is doing. And think about that. I'll remind you of that. If you take that amount, total assets, and subtract current liabilities, what you're left with is long-term liabilities and equity, which is really the two main stakeholders, if you remember, of the business. Right? The owners and the long-term debt holders are number one and number two in that hierarchy of stakeholders for a publicly traded company. So you're going to see some of those measures. And then you're going to see things that one of the drawbacks with GAAP, with financial accounting, is we do not include adjustments for inflation. And if you look at IFRS, which is the International Financial Reporting Standards, which we've been trying to move to for, almost the last 10 years, and we can't get it done because there's just so many differences and so much disagreement on it. But IFRS does allow companies, publicly traded companies, to adjust their fixed assets, their productive assets for inflation. So you can make adjustments to the books for appreciated land values, for instance. They don't go through to the income statement. They affect equity directly because they haven't been realized, right? They're just estimates of values of land that you've held for a period of time. So, this company is looking to add a measure for inflation, and they're incorporating that in the replacement value of some of their assets. So you've got to contend with that. And then you also have to contend with issues of working capital. So let's expand on that a little bit. Working capital is your current assets, which would include things like cash, accounts receivable, inventory, and any short-term prepayments, and subtracts from that current liabilities, which includes accounts payable, wages payable, interest payable, income tax payable, unearned revenues, those kinds of things. So working capital is the difference between those two categories. So most companies try to run that no more than 2 to 1. You don't want to inflate the short-term assets relative to short-term debt. You want to stay pretty lean. And many of your companies now are using practices to ensure that their inventory levels are pretty low. So oftentimes you'll see companies geared up so that when a customer order comes in, they actually then initiate the production process. So they've got a certain amount of raw materials on hand, but they don't stock until they get an order, right? They don't create an actual unit until they get an order. And be just-in-time type of manufacturing. So the reason why we do things like that is so we don't have large stocks of inventory that suck up resources. So that requires us to fund those investments because we have to pay for those usually within a 30-day period. So they're looking to assess a charge for the product managers for tying up a lot of working capital. And that makes sense, right? You don't want them to do that. So make it counterproductive for them to make those decisions. So that's kind of the idea there. Then they're looking to assess some other kinds of overhead, and product managers are arguing, and I've talked to you about this in the last couple of cases, starting with week 6 when we did Blackheath. I briefly talked about it. We definitely dealt with a small overhead charge in the last case. So here we are again where they're trying to assess an overhead charge, and the product line managers are saying, whoa, wait a minute, I don't have any control over that item, and you shouldn't be assessing me or evaluating me based on things I can't manage. And I totally agree with that logic. So these are the kind of things that you're going to be looking at and you're going to be analyzing. I've tried to break it down in such a way that it guides your critical thinking because it's jam-packed with data and information. And you've got multiple levels and structures and different things. I wanted to point out one other thing, too, that I thought was really cool from this case that doesn't often get addressed in accounting, but it's certainly a strategic concern. And that is that most of the measures we use to evaluate performance are based on, how much profit did you bring in, or how much did you make, what was your return on investment. So those are all going to be driven by profit numbers, what's your return on sales, all going to be driven by your profit numbers and your revenue numbers. But sometimes, and this was alluded to in the case, we use what's called a loss leader, or we try to gain market share, which might mean that we have to compromise on price to get that volume, right, to snag it away from our competitors. And those situations are not going to create favorable profit results. So if a manager has been charged with doing that to gain market share, Perhaps an argument should be made that somehow that needs to be factored out of the regular analysis if you're going to use the same system from manager to manager. And you're not picking up that in your measure. So nowhere in any of the measures that you see in this case are they looking at volume. Okay, only with regards to how it affects profitability, but not with the impact of looking at just growth for growth's sake or for gaining market share or other aspects like that that are for long-term value creation. And this is quite often what problems result from, especially fraudulent problems, is that we're too short-sighted, too short-focused, and we don't incorporate measures that capture long-term strategy and long-term growth. Or even things such as corporate social responsibility or environmental sustainability generally never make their way into these accounting measures. So I think it's something that's an interesting issue for us to tackle, and I would like you to consider it. So there's tons of learning objectives. Let me talk briefly what this means. Investment center is any subcomponent of an organization. So again, we're talking about a parent with subsidiaries. So this subsidiary is responsible for making decisions about product lines and profitability, and also about investments that they're going to make in additional productive capacity, so fixed asset investments. So any organization or subsidiary or company that is making both of those types of decisions, so product or profitability decisions, as well as investments and assets decisions, that would be considered an investment center. So an organization can be set up in any way a parent chooses. And Lipton is set up as an investment center. So that's what you're getting at there in the first one. I already talked to you a little bit about the second one, goal congruence, where in this case we've got some problems. So I'm going to have you work on that. Then the third one, computing investment centers, return on investment statistics, residual income statistics, economic value added, all that stuff's packed into this case. So you'll learn how to do that. Fourth, how a manager can improve that by increasing either sales margin, so that's the return on sales, where you take net income divided by sales, or capital turnover, and that's where you take sales and you divide by average assets. So you're getting an idea of how many dollars in sales do I generate for every $1 of asset investment that I make. So both of those are components of return on investment. And the fifth one, advantages and disadvantages of both. So I'll have you look at that. And the sixth one, how to measure divisions, income, and invested capital. So there's different ways in which you can do that. Okay, so this is part of the challenge I had told you about, is that the systems are not in agreement. Right? The parent and the subsidiary systems are not in agreement. So the challenge that they have here is revising the traditional profit-oriented product line income statement, and they would like to make these changes that would better align the subsidiary to the parent. So this person, Logan, has designed a new system, and they want to do a trial run with it, and there's various feedback situations that are given in the case for product line managers and others. So I ask you to look at that and discuss those issues that they raise. So in tab 1, you're going to compare Unilever to Lipton. So you're going to assess that goal congruence. Tab 2, you're going to compare Lipton's objectives to product line trading profit and assess goal congruence from the subsidiary level to the product line level. And then evaluate both of those situations. Tab 4, suggested changes to that measure. And tab 5, advantages, concerns, and recommendations that you would make. All right, so again, this is a very challenging case. I really look forward to how you do with it and the questions that you raise and the insights that you have about it. Let me know if you have any